Welcome, everyone, to Real Estate 360 Live. I'm your host, Ryan Sloper. For those of you not familiar with my show, my guest and I will cover every angle of real estate under the sun, from interest rates to the economy to what's happening in Washington. Anything that affects our real estate locally, we will cover here. If you got credit issues, you can call me. If you want to refinance at the lowest rates in U.S. history, call me. If you want to find out anything, whether it's regardless of your situation, if you're in a potential situation where you're going to need to short sell your home, whether you're trying to avoid foreclosure, whether you're considering a loan modification, we're here to help. And if I don't have the answer, I will put you in contact with the person that can help you. Make sure that you join us every Monday at WNEW 1580 AM from 2 to 3 p.m. in the afternoon. And you can call in with any questions to our off-air number, which is 877-245-2030. That's 877-245-2030. Or reach out via the web at realestate360live.com. That's realestate360live.com. Remember, if it's real estate, it's covered here. Got a great show lined up for you guys today. Joining me on our panel to discuss today's issues is Louis Cammarosano, who's the general manager of HomeGain. Louis is often cited in the media as an industry expert in the Wall Street Journal, Forbes, CNN Money, Fox Business, Smart Money, MSN, and numerous others. We're going to discuss with you about what happened in the markets last week, as well as letting you know what's on deck this week that can affect you and your real estate decisions. Louis, are you there?
I'm here, Ryan. How are you today?
I'm doing well, Louis. How about yourself?
Excellent. Thank you.
I know we were talking briefly off air that, I've just enjoyed, I had a little stomach bug over the weekend, just enjoyed watching the March Madness. So it was kind of, one of those weeks we spoke last Monday that, was one of the most unproductive work weeks of the year. I was interesting to note, though, Louis, I made a very, I think, astute observation as I've been going to, a restaurant to catch the early games on Thursdays or Friday for the past, however, 15 years. And as I was in Glory Days, which is just a small, sports bar type restaurant, I went there probably about, maybe 3:30 in the afternoon or something like that. It was dead empty. Now, I'm not really sure what that means, if it means that just people are less interested in basketball this year, which I highly doubt. But to me, it was more telling that there's just not as many people out there willing to take and go to the restaurant or bar and spend money actually there and rather watch it at home. That's more of what I think is going on there.
You're probably right. It's more economical to buy a case of beer and invite your friends over than to sit in a pub for 3 hours. Absolutely.
And, in years past, it was packed. You couldn't even get a seat in there if you weren't in there by 12 o'clock. So, it was just, it was kind of blew my mind. A couple of my buddies and I were sitting around being like, well, when is everybody going to show up? And nobody did show up.
Now, maybe you were just in a bar that wasn't popular anymore.
I guess that's a possibility.
But it would make sense economically that people can still enjoy themselves. Basically, you go to these places with your friends and you stay with your friends. You don't need any distractions because you're watching the game.
Right, and it's more about, the atmosphere and kind of, everybody kind of gets pumped up for that first, the first day of games, and just a meeting place. Typically, most people wouldn't, necessarily go to somebody's house at 2 or 3 in the afternoon to do that. So I guess there's just a lot less appetite, a lot less money out there. And more of my point is just kind of that, I feel like a lot of what's going on in the economy, there's a lot of misinformation out there. Obviously, we've seen the stock market. The Dow's up over 13,000. I think that the stock market is way overbought, and it's definitely due for a pullback. Now, I'm not a financial advisor or anything like that, but this is just my observations and opinions that I think that, with this low interest rate environment, it's allowing a lot of big-time corporations and banks to make these investments and really give a false sense to the general public of what's going on in the economy. What's your take on what's going on in the stock market and where you see things going from here into the next election?
I think you hit the nail on the head, Ryan. The interest rates are artificially manipulated. So why would you be surprised that the unemployment rate isn't artificially manipulated? Why the rate of inflation isn't artificially manipulated? In reality, what you have is a situation where in the last 5 years, people got over-leveraged and they owe a lot of money and the economy isn't good. And until those debts get liquidated and flushed out of the system, you're really not going to see much of a recovery. However, that's not the picture that they have to paint. They have to claim that they're keeping interest rates low so that credit is available. And we know credit really isn't available, even though interest rates are low. And the interest rates are low really to protect the banks because they can't absorb higher interest rates right now, nor can the U.S. government because of the amount of debt that we owe. interest on the debt rises, then we're in big trouble. So they're trying to make it sound as if this low interest rate environment is really helping the economy. It's cutting unemployment. It's keeping inflation in check, which it's not. Now, that may be our view of the world. However, we can take advantage of that because if interest rates are low and they plan on keeping them low or manipulating them low, as we've been saying, getting that long-term 30-year mortgage on a home that you want and locking in your cost of shelter over the next 5, 10, 15 years is a smart move because if inflation starts to, we already have inflation, which is defined as the increase in the money supply, but if that starts to show up more in the price of rent and other finished goods, count your blessings that you have a 30-year mortgage where it's not going to change, 30-year fixed mortgage.
Yeah, I agree with you 100% there, Lewis. And it's interesting because if you remember me saying last week, be very careful ahead of the Fed meeting for the language that was going to come out and how that could really sway interest rates one way or the other. Lo and behold, they came out and basically said that the Fed was saying that the economy is basically looks like that it is moving in the right direction. Employment's starting to pick back up. And what kind of employment? Part-time jobs,
low-paying jobs, and so on.
Yeah, and it was interesting because I actually pulled an article by Bob Livingston that actually showed that, that Bureau of Labor Statistics that was announced as of March 9th that there was 227,000 new non-farm payroll jobs were created. There was a statistician, John Williams, that reports that 44,000 of these jobs, or 19%, consist of an add-on factor derived from the BLS's estimate that 44,000 more unreported jobs from the new business startups were created than were lost by unreported business failures. The BLS's estimate comes from the Bureau's birth-death model, which works better during normal time but delivers erroneous results during troubled times, such as the economy has been experiencing during the past 4 years. So if you take out the 44,000 added-on jobs, that leaves you with 183,000, which is basically not doing anything. And even probably I would say that the 183,000 is not really you got to take that with a grain of salt as well, because of that, I want to say, 20% of those reported new jobs were waitresses and bartenders, which tend to be, in and out of the market all the time. So, I mean, as far as like long-term sustainable jobs, they're really not out there. I mean, really, the stock market is rallying on this number, which really I think is at best, overstated.
Well, what the stock market is rallying on is the fact that you really can't put your money anywhere else other than in the stock market if you have any money, because putting it in a bank, forget the fact that you may have risk it. The bank may go under, you may lose it, but the risk you take there is that you only get 1%, if that, interest on your money when the stated inflation rate, the official number is 2%, so you're officially down 1% of your money if you're trying to save it. So you're forced to put it in a risk asset, something that might go up, and stocks have been going up merely because I think there's a lot of volume. There's a lot of money chasing stocks for that reason, not necessarily because they believe that the stock market is a good place. It's really the only place other than going out and buying real estate or gold and silver.
Yeah,
those markets are not as liquid as the stock market. So the bulk of the money ends up in the stock market, and it causes the price to rise.
Yeah, and then at some point, I mean, a lot of analysts says it creates another bubble.
Absolutely. You've got a bubble in the bond market, and you've got a bubble in the real estate market. And everybody's claiming you have a bubble in gold and silver, which is not true, because bubbles are created when they're overbought, and everybody is chasing some form of stock or physical gold or silver, and that's not happening. I mean, right now, I would challenge the average person to name 3 gold or 1 silver mining company. Those stocks aren't overbought, and I would also challenge people, you go to the pub and ask them if they own any gold or silver. They don't.
Right. Well,
you'd have to have, pretty much, if you remember during the internet bubble, everyone had an opinion on a hot internet stock.
Yeah.
No one has any opinions on the gold or silver stock mining stock.
Yeah, that's definitely true, and it's funny because when I'm watching the tickers and watching, if let's say the Dow's up for 200 some points on the day, it's not like all of a sudden you look over at gold and silver and it's down like 5 or 10%. It's down a little bit, but it's very moderately down. You know what I mean? Like,
it is down, and also, Ryan, a lot of people don't have excess capital anyway to invest in anything.
Yeah, I agree.
A lot of this money is really the ultra wealthy are throwing their money at stocks because it doesn't make sense to put in the bank.
Yeah, 100%. I mean, I believe the same thing, and it's just I'm really a believer that what's going on here. It's just not sustainable. I mean, we keep printing money. I mean, you had sent me an article last week of like the unintended consequences of money printing, and I believe it was it Mark Faber that was quoted in that article?
It was Mark Faber of the Gloom, Boom, and Doom report.
Yeah, and basically, saying that that the currency devaluation that we're going on is creating all this malinvestment that's leading to asset bubbles. Basically, the same thing that went on back from 2003 to 2008 is what's going to end up happening here. And that there's no way for any of these countries to stop the money printing that's going on, and it's going to have to continue because it's so far gone. Would you agree that that's likely to continue?
That is the only thing that the central banks know and understand, and it's really their only hope to get themselves out is to keep kicking the can down the road. But as we said, that road eventually is a dead end. And none of this is new theory. I mean, Henry Hazlitt wrote in the 50s and 60s about the unintended consequences of money printing, and he took the concept of the unintended consequences from Frederick Bastiat. I mean, a lot of economics is based upon central planning, current Keynesian economics, central planning and interfering with the markets, but eventually it catches up with you. You can't just print money and hope that you fix the problem. You can't solve a debt problem by adding more debt on top of it.
Yeah,
it just creates inflation, and it really creates a tremendous bubble.
Yeah, and while the Fed may not come right out and say it that inflation's going on right now, it is going on.
It's temporary, is what Bernanke said. He anticipates it's temporary, as if one person who's been wrong many times can be trusted to claim what's going to happen in the economic environment. Yeah,
I believe like his answer to oil prices is that they're likely to subside.
Why?
Right, exactly. He doesn't have an answer for that. Just leave it at that. And we were discussing last week about the Fed and their meeting and their language and all that, and what that caused was a 0.25% rise in interest rates. Okay, so for many people that were sitting on the sidelines thinking, the Fed's going to come back and say that they're going to hold rates low through 2014, that the economy's not on stable ground. Not so much. That's not what happened. And in essence, what we really got was the 10-year bond breaking through a level of a ceiling that has been there for probably 6 to 9 months, that it actually broke through finally. And now I think that it's going to be very hard for us to get back to the lows that we've just came from.
Well, what's interesting, Ryan, is that was not what they wanted to happen.
I know.
So it highlights that even in a centrally planned economy, that really the planners cannot predict or even obtain the result that they want through their officious intermeddling with the market.
And there was actually another article that cited that almost 90% of the market is saying that there's no way that the Fed will keep interest rates this low through 2014. Why would they say that? Because they know that if they continue to keep interest rates that low for that long a period of time, that the inflation will go out of control.
Well, in order to do that, they have to keep monetizing the debt and keep buying recklessly U.S. bonds or other assets and increasing their balance sheet and putting more money into the system. Because remember, the way they do it is they create the money out of thin air to purchase the bonds that no one else wants.
Yep. Yeah, and then, what they actually said is there was no mention in the Fed's meeting of, QE3 coming in and buying more mortgage-backed securities, which would artificially manipulate the mortgage markets. So they didn't mention anything like that. Now, if the Fed's not going to continue to buy that, there's really not any other buyers, because now there's more an appetite, since the consumer sentiment is now rising and it's more, jovial, that there's more money going back into the stock markets, less in the bond markets, which is ultimately putting upward pressure on interest rates. So,
unfortunately, Ryan, whatever they announced is only half the picture, because you find out just with that limited audit, the amount of money that went overseas, we never heard about this. So they could be, who knows what the Fed is doing right now, what they're buying, where they're sending money, and so on. And there was that story where they were funneling money to foreign countries so that they can purchase U.S. stocks.
Yeah. It's really absurd, probably, what they're actually doing with the money. And if they end up auditing it, it'll be 2 or 3 years later. We're going to find out it's going to be too late. We're up on a break. When we come back, a 14-year-old girl in Florida buys a foreclosure. Find out how and why she did that when we come back.